reported a strong order inflow of rupees 3 lakh crore in the financial year that ended March, and its order book stood at 4.7 lakh crore. But if you were to look at the share market, looks like the analysts and market community are not very excited. The shares have been in the red for the last 2 days since the company reported the results. To find out what's happening with the company and to talk more about the way ahead, I have just the right person with me right now, President and Chief Financial Officer R Shankar Raman. Welcome to Moneycontrol, Mr. Raman.
Yep. Thank you. Thank you very much.
Mr. Raman, like I said in the introduction, your numbers seem good, the order inflows seem good, but it looks like people have reacted a lot to your margin outlook of 8.25% that you have given for FY25. It seems like that has not gone down very well with the market, and they are probably expecting some concerns over EBITDA margins going ahead. Help me understand what is the concern here and how would you read their reaction?
Good morning, Rachita. Good morning, viewers. Let me start with one factual correction. Rachita, the 10% profit growth that you spoke about is the Q4 year on year.
Right.
For the full year, financial year FY24, the profit after tax grew by 25%. And that coming on the back of a 21% growth in revenue and a 30% growth in order inflow actually makes it a well-rounded, solid performance by the company. But having said that, it is also a fact that while the overall margins at the portfolio level, the company has printed 10.6%, the projects and manufacturing business have printed a margin of 8.2%. This 8.2% is what has been receiving a lot of attention over the last 2 days. And it was in the context of 8.6% of the previous year that the 8.2% has caused some flutter. But let me try to context this for you and through you to the investors in the market, that normally profit is one side of the coin, profitability in terms of margin. The other side of the coin is the resources that we deploy to earn that profit. When we earned 8.6% margins in our projects and manufacturing business, our working capital intensity was much higher at almost 18% of revenue. When we are reporting 8.2% for FY24, the working capital intensity is 12%, a very sharp decline from 18 to 12. What has gone unnoticed is how much of the resources has the company deployed to earn the profits that it has done. This focus on one element of value creation to the exclusion of other often creates the disappointment that we are seeing, and I think it is our duty to correct that perspective. And thank you for the opportunity for doing that. Secondly, I think it is also equally important to understand that the business mix of the company is undergoing dramatic change in terms of project business. Earlier, 22% of the projects that we used to do was for international markets. Today, the share of international projects orders in the order book has now almost become 40%. Now, this has most certainly implications. One of the reasons why capital employed improved dramatically was the international orders as better cash flow arrangement during the course of execution of the project as compared to Indian projects. Indian projects, the cash flows are back-ended. And in the international market projects, the cash flows are more even-ended and sometimes front-ended. Given this change, there is obviously time value of money that will come into play when it comes to bid evaluation. We obviously will charge differently if you're going to receive money 1 year, 2 years, 3 years down the line as compared to receiving money on day 1, day 2, day 3. If you adjust for the time value of profits, then the margin of 8.6 to 8.2 will not look like a deflator, but it will actually look a step better than the 8.6 that we reported last year. Having said that, we're not saying that the efforts to improve the margins from 8.2 has ceased. We will, of course, do everything possible within our control to make sure that we operate more and more efficiently, more and more profitably. That improvement in profits is going to come not just by the client giving us better price, it's going to come through productivity improvement. It is going to come through utilization of digital technology, etc. And those are levers anyway that we are working on, and they are work in progress. But I just want to set the fears at rest that we are in a dipping profitability cycle. I think we are on a accelerating value creation cycle. At the time when 40 basis points dip in margin is getting commented about, we also need to see that 270 basis points improvement in ROE. The ROE is now close to 15%. It was 12.2% a year ago. ROCE is up 200 basis points. So when you see the context of profitability in a holistic manner, according to me, there is not so much to worry about in terms of company going through a free fall in terms of profitability.
Mr. Raman, that's very good perspective, and I'm sure your investors are listening in to your perspective as well. You have given a 10% order inflow growth guidance for FY25. Now, the interactions I've had with analysts, it looks like they expect order inflows from the Middle East to decline a little bit in this financial year. Now, if that were to happen, that will put a lot of pressure on you to win at a higher rate in India. So give me some perspective on what's the pipeline looking like overall, and what's the win rate you're targeting in India and in Middle East given these circumstances.
I think it's a good question because it does reflect the current realities and trends. Our prospect pipeline adds up to something close to 12 lakh crore. 60% of that is in domestic market and 40% is in international market. In domestic market, I think we are betting on continuity of the investment policy, the continuity of the growth model that we have been following for the last 3-4 years as a country, to say that we will invest first, create employment opportunities, develop the infrastructure around, and then achieve inclusive growth. And the digital footprints will also enable people to actually benefit from this overall development. That's a model that we have followed, and the government has actually reaped a lot of dividend out of this. And just look at the tax collection numbers that they have. I think it augurs well to believe that this can continue if there is going to be policy continuity. But the fact is, union elections have to get completed and the results have to be announced. So we'll have to wait and watch as to what happens to the policy continuity. But just sheerly from the potential of opportunities, the pipeline does look strong across the various sectors that we operate in India. When it comes to international markets, I think when it moved from 20% to 40%, the momentum was very visible, and the size of the orders were also sufficiently large for it to attract market attention. Middle East today is investing anywhere between $60 to $100 billion a year in terms of various programs that it is following. Saudi Arabia takes the lion's share within this. Almost $60 billion out of this is Saudi Arabia's investment budget on a year-to-year basis. What I hear from Saudi is that the investment momentum that was being pursued for hydrocarbons will possibly be moderated, and they would like to divert the resources generated by the hydrocarbon generation to more broad-based development of the infrastructure. At about $80 or thereabouts per barrel pricing, and it looks to me that the prices will operate in a stable range that generates enough profitability for the Middle Eastern oil and gas companies and for the government, which has been the largest investor. And the money that is generated through this is getting apparently diverted to areas like solar. You'd be possibly aware that 18 gigawatts of solar power projects L&T alone is doing in Middle East. It's a huge footprint considering the overall potential that we have for solar power. I think that momentum will continue, the tailwinds will continue in terms of more and more power getting generated. Middle East also wants to grow as an economy. It is developing new cities. It is connecting itself through railways. It's improving its port connectivity, etc. Given all this development, I think it is inevitable that they would need energy, and they are not going to go overboard on hydrocarbons as they used to do in the past 20 years. I think they will balance it out a bit. In some sense, I think responsible investing does take into account reallocation, and that's what is happening in Middle East. People are listening to Saudi Aramco in the context of a shrinking budget, but it has to be seen in the context of the broader economy investing same or more in terms of quantum. Saudi Aramco is talking about $10 billion per year for over 4 years, so about $40 billion of let's say lesser investment in oil and gas. But if you look at where that 40 billion is getting substituted, now building cities like Neom, and there are half a dozen other cities, building down ships, building railroads, building stadiums. In fact, they want to make Middle East a larger tourist destination than what Dubai is today offering to the world. Given all of this, and given that the population would require houses to stay, water to drink, power to switch on, etc., and the people need to be educated, entertained, and all of that stuff, the social fabric of Middle East is also changing. It is getting to be little less conservative, and that helps one half of the population, which actually has not been participating in the mainstream economic development, come and join forces. We ourselves as a company in our offices are seeing more Middle Eastern women coming and working. There are more people driving to work. All these are social changes, but not to be missed. And I think all of this in a broad sense will provide the opportunity. So when we look at Middle East over the next 3, 5, 7, 10 years perspective, we find that while the allocation to sectors could change left or right, the overall investment requirement and the ability of L&T as a company, having almost spent 25, 30 years in that market and having actually developed a reputation for completion, come what may. In the height of COVID, we still were working and delivering projects. Very few companies did that. A lot of companies actually scooted. Now, this has made our reputation formidable there. And I think with every success, the clients also appreciate that here is a company which can be partnered on long-term basis rather than be engaged on a contract-to-contract basis. So we are overall pretty optimistic. There will be these interruptions like the election-led, etc. To that extent, domestic market possibly will be a 8-month market in the year FY25. By the time everything settles down and new orders starts coming out, it could be July end, August. So that's something we'll have to take it in our stride and see how we can make up. So, which is the reason why a 10% growth guidance on order inflow on a very large base of 3 lakh crore. Looking just at the prospect pipeline, we could have always said there can be a 20% repeat, but we'll have to annualize the 10% on a 7-month basis and then still feel that we are guiding pretty healthy order intake for FY25.
Fair enough. That's a very comprehensive view of the Middle Eastern market. Mr. Raman, the power equipment business has been a tough one for L&T. I mean, you got into power equipment manufacturing at a time when the sector was struggling quite a bit. Now, given that history, I wanted to get your view on something that has come up recently with the Central Electricity Authority talking about relaxing the pre-qualification requirement that will allow companies which have so far been bidding for subcritical units to participate in supercritical projects. I mean, the idea is to encourage competition in this space, which was predominantly a two-player market with BHEL and L&T. How do you view this, and do you expect this to have a negative impact on your power equipment business going ahead?
Rachita, let me address this a little philosophically. Keeping aside the power sector per se, if you want larger participants, if you want larger play, more players coming and competing, dropping the pre-qualification is not the route. In fact, it is a wrong route. What we do is we drop standards. If you want more people to pass an exam, let's say, we can always make 10% as a pass level instead of 40%. More people will obviously pass. I think what is very important here is to tighten the pre-qualification experience so that people who come in to participate with reasonable confidence the project will be successfully completed in time within cost. Secondly, I think it's equally important to attract more people. The terms of trade has to be made more conducive. You see, I think it's important that the sponsors of the project, and particularly in the power sector, the tendency is to withhold retentions and guarantees until the project is done. And these projects are 4 years, 4.5 years, 5 years in terms of duration. The banking resources of the country will get stretched if they're going to be blockade of such retention, whether guarantees or amounts. So to that extent, I think what the sector should do is, rather than dropping the threshold, I think they need to make the terms of engagement more attractive so that more people will be coming forward. Now, if by dropping the threshold you get 10 more people coming in, where are they going to get the credit guarantee lines from? Even large companies like BHEL and L&T have hundreds of crores stuck in retention money and bank guarantees. Will the small players be able to afford that? Will they get the credit lines from the banks for doing all of this? And where are the resources? End of the day, the banks are also under pressure to keep providing even on standard assets to make sure that their capital is productively used. So where are they going to earn the profit from? The profit earned for the financial institution will be churn of the asset rather than blocking the limits. So I think what is required to be done in the power sector, particularly since you spoke about it, is I think the terms of reference for project awards, I think there has to be a deep introspection. And the Middle Eastern markets, not necessarily for coal-based power, but for other projects, have a lot of lessons to offer. They actually work with contractors as partners and not as somebody whom you employ. I have awarded you the project, you complete it, let me see what to be done at the end of the project. It's not the way to go. Awarding of the project is actually getting somebody to work shoulder to shoulder to make sure project gets done within time, within cost. The bane in Indian power sector is we are never able to complete projects in time. We are never able to get cash in time. And if these two, three things doesn't change, I think you can do whatever you want to do to lower the threshold. The participation will be very, very muted.
Mr. Raman, those are some fair points, and especially with respect to what you said on ongoing projects and, not meeting targets. I mean, there's something else that I would want your view on. How do you think the Reserve Bank of India's, draft that is proposing tighter norms for lending and more monitoring of under construction infrastructure project will impact project costs in India? And do you think that this could potentially catalyze, be a catalyst in terms of making sure that projects are actually completed on time in the country?
You got it right, Rachita. I think my take on this is, while it might look harsh at one perspective, that you are required to provide larger on even a standard asset, I think it helps better selectivity. I think we should never forget that India is a resource scarce nation. We might be doing well economically, people might be doing well, etc. But as a nation, we still have more need and wants than resources available. So it's very responsible of the central government regulator, Reserve Bank of India, to keep goading the lending system, the financial institutions, to actually take a lot of diligence and care in choosing the projects where funds have to be lent. We have had enormous instances where the projects were awarded to less than capable contractors. The projects were never completed. Even if they are completed with cost and time overrun. And that locked in more of the bank resources. So my own take on this is Reserve Bank has given the right signal by telling the lenders that please back projects which are capable of completion within cost, within time. What that means is the financial institutions, like the global financial institutions do. The global financial institutions pay a lot of attention to the vendors and supply chain partners. They go into details as to who are the people who are going to help complete the project. The Indian financial institution in the past used to go a lot on trust but verify mode, where the project sponsor gets evaluated, and if that person is competent, if the institution is competent, the rest was supposed to be taken care by the project sponsor. Whereas the financial institutions now will be forced to look at who are the components who are going to deliver to the project. And to that extent, that's a good step towards improving quality. But the short near-term effect of that would be some more rationing of resources. So I think it augurs well on a broader scale, and maybe over a year or two, this will settle down, and India needs good projects, and it needs projects which will be valuable for its own economic purpose. And this move, in my opinion, will support that.
Fair enough. Mr. Raman, you have spoken, a lot about the outlook in the last few days since the numbers came out. What about your divestment target for FY25? You have been gradually exiting non-core businesses.
Yeah.
Where do we stand on that, and what is the expectation from the current financial year?
We think we have done almost all the planned divestments in the strat plan FY21, FY26 that we have set for ourselves. We recently, as you might have noticed, completed the divestment of the road concession business as well. It was long in the works. It almost took 18 months to get all the various approvals that are required for change in ownership, but that's now done and dusted. Of the non-core, so to speak, the only two concessions that feature in our portfolio is Hyderabad Metro and Nabha Power. Of the two, Nabha Power is in a better place because it is today operating at about 85% PLF in a steady state manner. The Punjab state does depend a lot on this power plant production because we are the preferred supplier of power on merit order based dispatch, and hence the plant is running well, and it is generating close to 4,000 crores of revenue every year and about 400 crores of profits. So it's not causing stress on the finances of the company, but the fact is that we are not set up to run a power plant. So to that extent, it is a monetizable asset. The fact it is a coal asset means that the bidders would be limited because world is moving towards renewables. So to that extent, unless somebody who's already running coal power plants wants to aggregate with an addition of a good performing plant, then Nabha could be the answer. So we'll wait and watch as to how this goes. As far as Hyderabad Metro is concerned, I think there are a few things that we still need to fix before the asset becomes monetizable. I think in FY 25-26, we will get those fixed. And maybe in the strat plan of 26-31, we will see the divestments begin to happen for Hyderabad Metro. We need to work on improving the traffic that our teams are working on a daily basis. Today, close to 475,000 people travel by metro every day. That number has to go up by another 50,000 or a lakh of people, and we are at it. The second thing is the project deserved interest-free support from the government. We were able to work with the earlier Telangana government and got an approval of 3,000 crores. We have drawn 900 crores so far. The effort is on to draw the balance, and the money that will be drawn from the government will be paid, used to pay the higher cost debt that the project currently have. The third part of it is the transit-oriented development, the real estate that we have along with the metro lines. We have about 18.5 million square feet. We have monetized some last year. Some more approvals are pending with the government. Hopefully, after the elections, the dust settles down. These approvals will come in place and we'll be able to monetize some more money, some more land, and out of that we will use to repay the debt. So from a current level of about 12,000 crores of debt, if I'm able to get the project to about 8,000 crores of debt, get the ridership to go from 4.75 to 5.7 or 6 lakh people, then the project is in a much better shape for investors to have a look. It's a very long concession, 65 years concession. Yeah. Not very many concessions are that long in the country. And I can see lot of cash at the back end of the project. Back end meaning second half of the project. The first half of the project, the cash generated will go to retire all the debt obligations, etc. But somebody who is going to invest now with a long perspective, like a pension fund or a sovereign wealth fund, will have lot of returns to gain. But the point is the asset needs to be first made attractive, and that's what we are working on.
Wish you the best for that project. That's something you've been working on for a long time. Before we wrap up, one final question, Mr. Raman. This is the election year, and a lot of what you are doing is very closely tied up to how the government operates. What would be the one big challenge or for this financial year, and what is the one thing that you are watching out for?
See, the workforce have now some scattering effect because I think they all the migrant workers particularly, much of the project work is done by migrant workers, whichever part of the country we are working in. And because of the elections, most of them are returning back to their villages to cast their vote. Normally, this is a bit of a disruption which is painful, because you have to then disassemble the skill, reassemble the skill, and because of all of this, the timelines that we have for completion doesn't change. So I think the efficient way with which we get the workforce back of the right mix, right quality is something that's going to be key. So while I can sort of reflect and say till September, the order inflow expectedly will be on the lower side, but the work execution will have to come back quickly. So post June, when the monsoon months also begin, we have to get our workforce assembled. So to my mind, execution, how we navigate execution between now and September, will be an important factor that we will look at. Secondly, our execution is tied up to cash flows. And I did speak earlier in the program about how it is important to get the resource deployment under control and operate efficiently to provide overall returns to shareholders. So we have to make sure that our focus on cash flow management does not waver through this period of disruption, and that we are able to do what it takes to make sure we are ahead of the project. We hope that there is economic policy continuity, because we have benefited a lot from that over the last 3-4 years. Whichever government the people choose to form, I hope that the wisdom of growth first, investment led approach sustains. Nobody has specific answers today for some of these. We're just hoping and waiting with our fingers crossed.
Fingers crossed indeed. And thank you so much, Mr. Shankar Raman, for talking to us and sharing the perspective. Pleasure talking to you as always, and we'll be in touch. Thanks for joining Moneycontrol. Stay tuned for more interviews and coverage of earnings going ahead. Thank you.